Well, greetings and salutations, test takers. This is the Series 7 Guru, uh, also known as Dean Tenney, coming to you from my off-grid studio, getting our kicks on Route 66. We have a video called Your SIE Exam in 60 Minutes. Oh, I think it's coming up on 250,000 views. Unbelievable. People found it to be a great help, but it's getting a little long on the tooth, and there's been some changes in the exam since then. And I thought, well, okay, well, what do I want to do? Do I want to, update or call the SIE exam 60 minutes part deux? That didn't speak to me at all. So, what I decided instead is to start a new series that already has one in it that's been very productive and people find helpful called the Mighty 90. I did a Mighty 90 minutes on the Uniform Securities Act. And so we're calling this the Mighty 90 on your SIE exam. These are designed for the night before or morning of or both before your exam. You're certainly not going to learn it in 90 minutes, but it might help get you in a nice circadian rhythm. It's not a natural flow state to be, taking an SIE exam. So hopefully this can confirm some issues for you, get your brain housing group kind of warmed up before you start taking your exam. Okay, so let's get started on the Mighty 90 SIE exam in 90 minutes. Now, there would be no securities industry essential exam without securities. And you are held accountable for three issuers of securities on your exam. Corporate issuers of securities. Corporations always issue common stock. There's no such thing as an corporation has not issued common stock. May perhaps some debt. Municipalities. Municipal issuers only issue debt securities, and the U.S. government issues debt securities. We'll start with the equity securities issued by corporations. Now, in terms of business structure, if you want to form a corporation, you're going to need a corporate charter. And in that corporate charter, you're going to stipulate how many shares are authorized. That would be the maximum number of shares a corporation can issue under terms of its charter. Then we're going to decide how many shares we're actually going to place with investors or issue. Typically we're going to authorize more shares than we plan on issuing because we might want to come back to raise some additional equity financing. We wouldn't associate treasury stock with a new corporation because treasury stock are shares that have been purchased by the corporation. They go out there and retire those shares into the treasury. That treasury stock has no voting rights, pays no dividends, and can be reissued. So treasury stock is issued, issued less treasury equals what's called outstanding, right? So there's no treasury stock issued and outstanding would be the same number. Okay, so that would be stipulated in our corporate charter. The other thing that would be stipulated in our corporate charter is what style of voting are we going to use? Are we going to use statutory voting, also known as regulatory voting, where for each share I have a vote. And if I have 100 shares and we're voting on 3 board seats, 100 yes, no, 100 yes, no, 100 yes, no. Are we going to be using cumulative voting? In cumulative voting, if I have 100 shares and we're voting on 3 board seats, for example, I'd have 300 votes. I could split them in any fashion I'd like. That protects smaller shareholders because I can put 300 votes on one of those board seats. Maybe that's my buddy, maybe it's somebody I hate, whatever the case may be, and I have a greater impact. And then does the corporate charter have what's called super voting shares, another class of stockholders who have more than 1 vote per share? So super voting would have more than 1 vote per share. All right, so what might the corporation issue in terms of equity securities? Well, we mentioned they always are going to issue common stock. They may or may not choose to issue preferred stock. They may issue rights and they may issue warrants. Now, when they issue common stock, if you own common stock, what you are is an owner of the corporation. And you have a claim on the profits or what we call earnings per share. The board will decide how much of those earnings, if any, will be distributed to shareholders as a dividend. Please note, you do not have a right to a dividend. You only have a right to a dividend if declared by the board of directors. So be careful on that, right? No right to a dividend. You have a right to a dividend if declared. And again, you have the potential for price appreciation. Maybe later on you can sell that stock to someone else for more than or less than you originally paid. No, so you can make money from the income stream on the stock, assuming there's a dividend of some sort, as well as price appreciation. Those are the only two ways, by the way, to make money in investment. Those two things together are called total return. What I make from the dividend plus what I make from price appreciation. There is very little math on your SIE exam, but I would be prepared to do total return. You simply take the income from the investment plus or minus the price appreciation, divide by what it cost you, and that'll give you your total return. The corporation may choose to issue preferred stock. Very important to know that preferred stock is a senior security. Senior only to the common, but it's senior in terms of dividends, preferential treatment in terms of dividends. You can't pay a dividend to common if you're in arrears to your preferred stockholders, and preferential treatment in terms of liquidation. If we liquidate the business, we sell off all the assets of the corporation, we pay off all the liabilities of the corporation. The shareholders have a residual claim after we've taken care of those preferred stockholders. Now, the preferred stock dividends are stated as a percentage of par. And so it's important that if we know we're looking at a 6% preferred stock, that 6% is based on par, which is 100. And so we should know that's $6 annually per share. That would be $1.50 every quarter, right? So stocks, if they pay quarterly, and a preferred stock has a fixed or stated dividend. What we mean is you're not going to get more in this case than 6. You might get less, but you're not going to get more, fixed or stated. The other thing we have to be able to do on the test is compare rights and warrants. The existing owners of the corporation have a preemptive right. They have the right to maintain their proportion ownership. They have the first right of refusal on the issuance of new shares. And, it makes sense that if we can get the money from our existing owners and not have to hire an investment banking firm, that we could save some money. We pass those savings on to our existing shareholders to give them an incentive to subscribe, to participate in the rights offering. They certainly don't have to if they don't want to. Right? We can ask politely for additional capital, but we can't, as a corporation, demand it. So very test will know those rights are going to be short-term. Makes sense that the rights to purchase the additional shares are short-term because the issuer needs the money and they need it like now. And that they're exercisable below the current market price at issuance. That means, they have intrinsic value immediately, right? The intrinsic value would be the difference between the subscription price, I'll make up 1.4, and the market price of 5, that's $1, right? So that's to give you an incentive. You don't have to do that. Now, they have a right, they have a theoretical value. And again, if you don't want to exercise those rights, maybe we can sell them to someone else. The issuer might also issue warrants. Warrants are usually issued as a sweetener or incentive in bonds. I'll say as an additional sweetener to make the deal more attractive to you, we're going to view warrants as a bondholder to buy additional common stock, buy common stock in the issuer at a fixed price. Now, the test question about warrants is warrants are exercisable above the current market price at issuance, and they're long-term. So you got to be able to contrast rights with warrants on your exam tomorrow morning or today, depending on when you're watching the Mighty 90, right? You're held accountable for American depository receipts. American depository receipts are foreign securities that are traded in the U.S. market. What I'm buying is that in the foreign branch of a domestic bank, Citibank, for example, that in their Amsterdam branch, there's 1,000 shares of Heineken, of which I am the beneficial owner. That's easier than buying the Dutch security in the Dutch marketplace. Now, Heineken is a brewery. Now, what are the test questions? I told you they facilitate U.S. Citizens accessing foreign securities to add additional diversification to their portfolio. But the major test question is you have foreign currency risk. Right? If the underlying business is conducted in the foreign currency, and we're turning the guilders or euros in this case, I guess euros into dollars, we have that risk. That we're not going to get as many dollars. So we know that ADRs can best be characterized as foreign securities traded in the U.S. market. The ADR itself is a U.S. security, but remember what the receipt is for is the foreign security, and you have foreign currency risk. We talked about voting rights of a corporation. You don't have to attend the shareholder meeting to vote. You can vote by proxy without attending the shareholder meeting. And, broker dealers are not allowed to charge the forward proxy materials to their customers. So we're going to, if that proxy material comes to the broker dealer, we're going to go ahead and send that off to the customer. Okay, so they might issue a convertible preferred stock or convertible bonds. In this case, we're talking about equity securities. And this allows you to switch your status from being a preferred stockholder to becoming a common stockholder. It allows you to switch your status from preferred to common. Now, what I would know, whether it's a convertible preferred stock on your exam tomorrow or today, depending on when you're watching this, is to be able to do what's called the conversion ratio. And what that means is you should be able to take par. Let's say it's a preferred stock, 100, and I tell you the conversion price is $25. Take 100 divided by 25 and be able to tell me that's 4 shares. All right. So before we move on to debt securities in this mighty 90, one more thing we want to talk about is Rule 144. Control stock, control persons, and volume restrictions. So control persons are insiders, and all the stock they own is called control stock. So officers, directors, principal stockholders, they own control stock. Now, they either got the stock in the secondary market and that stock is registered, or they did not get it in the secondary market and that stock is unregistered. It's never been registered. Well, the way we turn unregistered stock into registered stock is we have to hold it at least 6 months. So if it's stock that is unregistered, sometimes we refer to that as restricted because it's restricted in terms of its transfer. You have to hold it for 6 months. Sometimes we call that legend stock because in the old days when there were stock certificates, there'd be a legend that says stop transfer. Those letters would be in red. So sometimes we call it red lettered stock or legend stock. The point is, if you're a control person, you own that stock, and it's stock you got directly from the issuer, not in the secondary market, you have a 6-month hold. As an insider or control person, if you got in the secondary market, there's not a 6-month hold, but you're always going to be subject to the volume restrictions of 144. You're going to file the form at or prior to your intended sale. That form is good for 90 days. And during that 90-day period, you can sell up to 1% of the outstanding stock or the average of the last 4 weeks trading volume, whichever is greater, up to 4 times a year, every 90 days, right? So 4 times a year. So 144, 144 is a good way to remember that. And I told you about that form. All right, let's move on and talk about debt securities that you're going to encounter on your exam. We said there are 3 issuers of debt securities. We said the 3 issuers of debt securities are corporate issuers. We'll talk about corporate debt. Municipal issuers. We'll talk about municipal debt. And US Treasury. And we're going to talk now about Treasury debt. And so Treasury debt, we have T-bills, T-notes, Treasury receipts, and Treasury bonds. You should know on your exam that T-bills are issued at a discount, as are other money market instruments like commercial paper, like bankers' acceptances. You should know that T-notes are 2 to 10 years and they trade in 30 seconds. And you should know that bonds, Treasury bonds, also more than 10 years, trade in 30 seconds. And Treasury receipt is a type of zero coupon bond, where you buy them at a steep discount. You get no interest payments. Bonds pay typically semi-annually, but not Treasury receipts or any kind of a zero coupon bond. And here what you would have is an imputed interest you're receiving, and you would owe taxes on that. So when you buy a Treasury receipt or any other type of a zero coupon bond, you have to do straight line amortization upward called accretion, and you owe taxes on that imputed amount. We also have agency securities. The one that you should be prepared for is Ginnie Mae. There are 3 test questions about Ginnie Mae. Ginnie Mae is the only debt instrument, the only investment we have that pays interest and principal monthly. Ginnie Mae has the full faith and credit of the United States government, the US Treasury. The other agencies, Fannie Mae, Freddie Mac, have an implied backing, but they don't have a direct backing. And they're fully taxable. So you should know they pay interest and principal monthly. They have a full faith and credit of the United States Treasury, and they're fully taxable. Now, as it relates to kind of a weird low probability question, but the Ginnie Mae's trade on a basis of the average maturities of the mortgages in the portfolio. So very low probability, but maybe you bump into that. Corporate bonds, we have secured bonds, and secured bonds are senior to unsecured bonds in terms of liquidation of the corporation, right? So assets minus liabilities, long-term liabilities. And those secured bonds could be equipment trust certificates backed by major movable equipment, collateral trust bonds, marketable securities placed in escrow, mortgage bonds secured by real property. We have unsecured bonds. The unsecured bonds would include debentures. Debentures just is a fancy word for a bond that has no collateral behind it, just the issuer's promise to pay. And we also have convertible bonds. And the same deal, you should be able, in a convertible debenture, to be able to tell me the conversion ratio. So in my previous example, par was 100 because we were talking about a preferred stock. In a bond, par is going to be 1,000. So 1,000 divided by 25. Where's my calculator? Hey, I'm arithmetically challenged. So anybody offers me a calculator, I say thank you very much. And we find out the conversion ratio is 40. All right, so municipal securities. The two basic types of municipal bonds we have are GOs and revenues. Cheers. I'm coming to you early in the morning here, so. Oh, caffeine tastes pretty damn good. I was teaching a class one time, and I asked where I could get a cup of coffee. They said, Dean, we have no bad cats on this campus. I said, what are the bad cats? They said, caffeine, alcohol, and tobacco. There's no caffeine, there's no alcohol, there's no tobacco. I said, oh man, that's a deal breaker for me. I need to start the morning with caffeine, in the evening with a little adult beverage, maybe smoke a stogie every now and again, so I wouldn't work. Now, the biggest testable distinction about GOs and revenues is that GOs are backed by the taxing authority of the issuer, whereas revenue bonds are backed by the user fees. User fees are insufficient. Those bonds will default, right? We have a short-term municipal obligations that municipalities use to even out the cash flow of their, monies, and those would be tax anticipation notes, revenue anticipation notes, tax and revenue anticipation notes. Those are short-term municipal obligations. They have a unique rating associated with them. I doubt you'll see it low probably, but they're called MIG ratings. MIG stands for Moody's Investment Grade, so MIG 1 would be better than MIG 2. Other debt instruments you're held accountable for would include bankers' acceptances, negotiable jumbo CDs, and commercial paper. So, the definition of money market instruments that would be found in a money market fund is high quality debt maturing in less than 12 months, like a negotiable jumbo CD. Negotiable means that it's a CD that can be sold to a third party. So that's what the word negotiable means. Jumbo means $100,000 or more. You should definitely know that bankers' acceptances, like T-bills, are issued at a discount. They have a 270-day max maturity, and they're used to facilitate foreign trade. Commercial paper is large unsecured borrowing by corporations. It too is issued at a discount, and it too has a 270-day max maturity. Now, we have varying maturities. We have what's called term maturity for bonds, where all the bonds come due at once. And we have what is called serial maturity, where the bonds are coming due at different times. So, you buy a bond to generate income. The bond is going to pay you interest semi-annually. So we have, again, it's like learning a foreign language. They say when you dream the foreign language, I guess that's when you know it, right? So we have bonds pay semi-annually, and that is called the nominal yield, the fixed or stated rate of return, or the coupon. Well, will they tell you, call it on the test, whatever you're not prepared for? Now, that does not fluctuate. What the issuer is going to pay someone doesn't fluctuate in the secondary market. So if it's a 6% coupon rate or a 6% nominal yield or a 6% fixed or stated rate of return, all of that means the same thing. 6% times par, you're going to get $60 in two semi-annual installments of $30 per bond, right? So it's again important that you can turn the 6% into $60 in this case. Remember, be careful. 6% on the preferred was $6. You got to be a little bit careful about that. Par value we said is 1,000. I would be prepared to calculate current yield on your test tomorrow morning or today, depending on when you're watching this. And current yield is what an investment pays you divided by what it costs you. Current yield is what it pays you divided by what it costs you, right? A good way to remember this is AMP. A is for annual interest or annual dividend, depending on whether it's a stock or bond, divided by market price, MP, market price. Is there test math? If you tell me you missed your mark this morning because of the math, I'm going to say, well, you had bigger problems. There is some practical application. I told you perhaps total return. Most certainly, I think you'll see current yield, but there's not a lot of math that will make or break you. The other yields you should be aware of are yield to maturity. Most people who buy bonds don't buy them based on the coupon. They based on what they would make by either holding it to maturity or holding it to the call. And you will get a question or two about the relationship of those yields based on interest rates. Right? You should know that if interest rates go up, the bond price is going down. That will not affect the nominal yield, as we said previously, but that would affect whatever the current yield or yield to maturity or yield to call would be. The main one that shows up on the test is about a bond that you would buy at a premium, and recognizing yield to call would be the effective or lowest yield, and you would expect to receive that. The two risks in bonds are interest rate risk and credit risk. And credit risk is identifiable or can be quantified by looking at what's called the credit rating. And the one they test on you on is recognizing below what credit rating is a bond less than investment grade. So triple B is investment grade, double B is not. So below triple B, bonds are less than investment grade. Now, another risk you have, we said one risk you have with bonds is interest rate risk. Interest rates go up and your bonds in the secondary market go down. We said another risk you have is credit risk. Another risk associated with bonds, counterintuitively, is the risk that you don't get to hold the bond to maturity, as I mentioned. You might have what's called call risk. And call risk is associated with declining interest rate environment. You know, the issuer reserves the right to call the bonds away from you and replace high cost debt with low cost debt. Right? So that's one of the risks you have. Call risk is associated with the declining interest rate environment. Now, there are two types of bonds where we do have no call risk. Those are zero coupon bonds and Treasury securities. If a bond has a call risk, it will also, the issuer will provide what's called call protection. They'll give you call protection in terms of time. The issuer will say, we won't call the bonds for at least 5 years. I just made that up. And if we do call the bonds, we'll give you a prepayment penalty. So, you know, if a client says, what's the call protection? They're asking me how long before the issuer can call the bond and at what price can the issuer call the bond. Short-term versus long-terms, we should know that long-term bonds have a more volatility than short-term bonds. The way to remember this is long and low. The bond with the longest term maturity and the lowest coupon is going to have the greatest volatility, long and low. We talked about that inverse relationship. In terms of how we underwrite bonds, there's two types of underwritings. You know, there's negotiated underwritings where the issuer selects the underwriter. You know, I think the analogy here would be how to do your mortgage, right? In a negotiated mortgage, I simply walk into my bank and say, I need a mortgage. And if you don't give me a good deal, well, then you're not only jeopardizing this transaction, but future transactions. Competitive is, hey, don't kid yourself. When I walk out of here, I'm going to see who can give me the mortgage at the best deal. So if it's a competitive underwriting, it's going to be the one who wins the syndicate that provides the issuer with the lowest net interest cost. What that means is the higher price, because remember, the higher the price, the lower the yield. So we're going to put it out to auction. That's how that would be done. Now, if you're going on to your Series 7, you may as well overlearn options as it relates to your SIE exam. But like math, options aren't going to be something I'm going to believe you had a material impact on whether you pass or do not pass your exam. Most of the questions you're going to get as it relates to options are going to be recognition questions, not practical application, not judgment. We have two types of option contracts. We have calls and puts. And you can either buy them or sell them. So that means we have four basic option positions. We have long call, short call, long put, short put. I think a lot of people get hung up on options unnecessarily. There's, only two types of options. You can buy them or sell them. That means there's four basic option positions. A long call or buying a call gives you a choice to buy the stock at the strike price. A short call gives you an obligation to sell the stock at the strike price. A long put gives you a choice to sell or put the stock to somebody at the strike price. And if we're going to have putters, we got to puttees. A short put is an obligation to buy the stock at the strike price. Now, we also have option contracts that are not based on stocks. So we also have what are called index options. Now, I would know that index options settle in cash. What does that mean? That means if I am short an OEX, that's the Standard & Poor's 100, I don't have to deliver 100 shares of 100 stocks. If I'm short, I simply deliver whatever the intrinsic value is, the cash equal to that. In an equity option, if I'm short an Apple 220 Go, I actually got to deliver the stock. So that's what that means. It's a name and shoot, point and click question. That equity options do not settle in cash. In other words, what we mean by that is you have to deliver the underlying, the stock, whereas index options do. Now, you're either coming to the options market to either speculate on the stock price or to offset risk. So we have two players in the option market. We have hedgers. Hedge is a fence, right? Keeps good things in, bad things out. And if I'm a hedger, I'm coming to the options market to hedge my stock position. And the stock would be the, dominant position. And if I'm speculating, I'm simply betting on the stock price. That would be our basic option positions. So the two stock positions we have are long stock and short stock. If I'm long a stock, the appropriate hedge would be to buy a put, a protective put on my stock position. I also might want to generate additional income on my stock position. That would be a short call, covered call. I do get reports on long the stock and buying a put, right? And if you get I told you very few strategy questions, but if you're long the stock and you buy a put, the break even is going to be what you paid for the stock plus what you paid for the protection, where people get hung up on that sometimes and they go, oh, it's a put, I'm subtracting. Well, not if you have the stock position, right? And if you're short the stock, I always say don't be a dumb bear. There's two things here that could subject you to unlimited risk. One is a naked call where you agree to sell stock you don't own, the naked uncovered call. Another is shorting the stock without an appropriate hedge. And so if you could establish a choice to buy back the borrowed stock at a set price any time between now and some future date, you'd be okay, right? So the effective hedge on a short stock position is to buy a call. I think you should fail the entire exam if you miss expiration date. I can't imagine any draw of your SIE in which you do not get asked, when do options expire? 11:59 Eastern Time, the third Friday of the expiry month. That's very, very testable. Contract specifications. I've hinted at contract specifications. Contract specification would be what type of contract is it, call or put, plus the stock, plus the strike, plus the expiration. The premium is not part of the contract specification. The premium is what you pay or receive for that option position. Now, you should know on your exam that opening purchases are how you establish a long position. So if you want a choice to buy the stock or a choice to sell the stock, long call or long put, you're going to know opening purchase. An opening purchase would be used to establish or add to a long position. If you want to create an obligation to sell the stock, short call, sell a call, or an obligation to buy the stock, short put, you're going to do an opening sale. Opening sales, test question, are used to establish or add to a short position. And then, you can decide, well, I shouldn't say you can decide. If you are doing the opening purchase, you can then decide whether you want to trade the option, exercise the option, or let the options expire, right? So that's what happens with an option contract. It can be traded, it can be exercised, it can expire. We talked about cash settlement for index options. We talked about delivery of the stock in an equity option. We said index options settle in cash. Every once in a while, you get asked about this relationship of the market price to the strike price. And a good memory aid device for this is call up, put down. Not asking about investors, be careful. We're simply asking about the relationship of the market price of the stock to the strike price of the option, right? So if Apple is 221, it's a 220 call, 220, 221 call up. The market price is up from the strike price. So that contract is in the money by 1 point. It has what we call intrinsic value. If it's an Apple 225 call and Apple's at 221, the contract is out of the money. It has no intrinsic value. Please note, I'm not asking you about an investor. I'm simply asking about the relationship of the market price to the strike price. So just be careful on that. These are terms that aren't about the investor. It's about the relationship of the market price to the strike price. We talked about uncovered. Uncovered means you don't have the stock, right? So the one here that you could test on again is uncovered or naked is a call where you agree to sell a stock you don't own. And the test question is recognize that subjects the investor to unlimited risk. You should definitely know the difference between American style and European style. American style means you can exercise anytime. European style means you can only do so at the end. American is typical of equity options, and European is typical of non-equity options, exercise at expiration. Various strategies I wouldn't worry about, but I would certainly worry about the options disclosure document. This is extremely testable. So how do we get the account open? Dado 15 is a good memory aid device for your test either today or tomorrow. Now remember, we're not saying you're going to learn this SIE watching this 90-minute video. We never said such a thing. We said this is helpful the night before or morning of or both to get you thinking about these issues, confirm what you know, kind of set you up for a good, nice rhythm of flow state before your exam. So I give you the OCC disclosure document at or prior to this thing, right? Typically it's going to be prior year, right? So I give you the disclosure document. I go back to my ROP. He says, Dean, did you give him the disclosure document? I say yes. He looks it over and he says, okay, I'm going to approve it. So that's the A. Dado 15, disclosure document account approvable. Now we do our first trade. That's the T. I tell you, within 15 days, I need back from you the option agreement that you read and understood that document. You can't possibly read it while I wait. So that's why, we give you this 15 days. Now, if it's 15th day has come and gone and this hasn't come back to us, we're going to only allow you to do closing transactions. We'll let you get rid of the stuff you already got. Right now, the OCC publishes that disclosure document, and the OCC is the issuer and guarantor of all option contracts. That true is a test question. So you say, Dean, how do I know if an exercise an Apple 220 call, they're going to deliver 100 shares of the stock to me? I say, well, how do they know you're going to deliver $22,000? Well, what you're asking about it to me about is contraparty risk. The risk the other party doesn't come make good. I say you don't have to worry about that. In between the players sits the OCC. Test question, they are the issuer and guarantor of all options. All right, you're going to get 3 or 4 option questions. I probably gave you 3 or 4 right there. I think what I just did is sufficient for SIE. It's certainly not sufficient for the 7, but for SIE, I think that's sufficient. You're going to get tormented on mutual funds. Mutual funds. Mutual funds are the number one product that most people get where they're going without crashing and burning. And you're going to get very much tested on the difference between closed-end funds and open-end funds. And the major testable distinction between a closed-end fund is it trades supply and demand in the secondary market, whereas an open-end fund is continually offering new shares to the public. So those are the major testable distinction between those two. You know, the number one reason you buy a mutual fund is to access professional management. The second major reason to buy a mutual fund is to get diversification. And the third reason is just ease of ownership. If we're going to start our own mutual fund, I don't know why we would, but if we're going to start our own mutual fund, more mutual funds than Taco Bell's, we have to classify ourselves under the Investment Company Act of 1940 as either an open-end fund, a closed-end fund, or perhaps, low probability, a unit investment trust. In a unit investment trust, the assets are professionally selected, but they're not actively managed. And if you get that, that would be the question. We also have what are called variable annuities. I think of a variable annuity as a mutual fund with an insurance wrapper. And what's nice about that insurance wrapper on the variable annuity is you're not getting constructive receipts of any dividends or capital gains distributions. And so that money is going to grow tax deferred. That's why we refer to variable annuities as a non-qualified retirement plan. Non-qualified meaning it doesn't meet the qualifications of the IRS to be using pre-tax money. You're funding it with after-tax money. You have a cost basis. And you can access those funds after you're 59 and a half. Now, if you've been, you're going to access these funds, it's going to be done last in, first out. The last money's into that variable annuity, that mutual fund. The mutual fund, by the way, the variable annuity is called the separate account. The separate account or sub-account is a mutual fund. So you have the investment risk there, just like you would in any other mutual fund. But the way you access that money is a LIFO. Now, in mutual funds, we have various share classes. We have the traditional A share. The A share typically has a front-end load, and it's good for somebody who has a long-term time horizon and a large amount to invest because they might qualify for what's called a breakpoint, a quantity discount. We also have B shares. B shares have a contingent deferred sales charge. And if you stay in the fund long enough, you might be able to you turn the B shares into A shares and avoid that load. Now, the test question about the B share is that's going to be suitable for somebody who has a long-term time horizon and a smaller amount to invest, something that is not enough to qualify for that break point. Now, we got to be careful on that because if they don't understand they got to stay in that fund a certain length of time, they don't meet that, that could be the most expensive kind of proposition because they'll get back flagged on that. And then we have C shares, and the C shares typically have an ongoing 12B1 fee. I would know, very testable, that a 12B1 fee is a promotional expense paid by the fund, promotional expense paid by the fund, not an expense associated with managing the money in the portfolio. No, a promotional expense to promote the fund. I would know that if you are a no-load fund, the maximum 12B1 fee is 1/4%. If you want to sound like a player, that would be 25 bips or 24 basis points, and still refer yourself as no load. If you go past 1/4%, you can no longer refer to yourself as a no load fund. And then in any circumstance, you can't go past over the life 75.75, 0.75% or 75 basis points or 75 bips. You are going to get tested on the NAV, the net asset value, the assets of the securities in the portfolio minus the liabilities of the portfolio, NAV. We have to calculate that every day, every business day. And we're always doing business based on the next calculation of the NAV, and that's called forward pricing. Right, and there is as I always say, a problem with having monkeys harvest bananas And the problem with monkeys harvesting bananas is they eat the product, right? So there's a management fee that you're going to be paying, for this, professional manager. The Be careful. The management fee is typically the largest single expense to the fund. Breakpoints, we said, be careful. Breakpoints are quantity discounts. And that's a good thing. A breakpoint is a good thing. It's like Costco, right? I say, man, I don't need 2 tons of salsa, but it's so cheap. A breakpoint sale is a bad thing. A breakpoint sale is where I'm trying to maximize my commission by avoiding the breakpoint. Right? So the easiest way to stay out of trouble here is to tell the client how to get the best deal. And so even if they don't have enough to meet that breakpoint, maybe I say, hey, do you think over the next 13 months you might be able to come up with this additional money? Because if so, we should fill out very testable a letter of intent. A letter of intent is good for 13 months. It can be backdated for 90 days. We don't allow investment clubs to pool their purchases for purposes of meeting a breakpoint. So the easiest way to make sure we're doing the right thing for the customer is tell them all the ways they can get the reduced sales charge. And a letter of intent is a good one for that. Now, under no circumstances can we charge more than 8.5% for a mutual fund. And that, too, is testable. We have 529s, our mutual fund securities. These are where you're either buying it's kind of similar to the mutual fund investment, right? Nevada, I'm coming to you from formerly Las Vegas, but Nevada, and UNLV has a 529 plan available, and it's managed by Vanguard. And so you would put money into this 529 plan, and it would grow, and you're using it to finance a college education. Now, what you need to be able to do on your exam is contrast a 529 with a Coverdell, and the 529 is, in the beauty contest, is always the winner because it's just so much more competitive that I know of no financial institutions any longer even offering Coverdells. One of the major advantages of a 529 is it is not means tested. Where Coverdell, you can only put it in $2,000 and, it's means tested. If you're worried about investment risk and you're worried about inflationary risk, you might choose a 529 prepaid plan. And a prepaid plan where you're just buying the bachelor degree off the shelf. You don't have to worry about any investments or any inflationary risk. The MSRB, the Municipal Securities Rulemaking Board, has no enforcement power, but they do publish rules, and they have said a 529 is a municipal security. They've also said that local government investment pools are municipal securities, and a local government investment pool is simply a money market mutual fund for cities and counties that want to pool their cash to get some kind of return by buying commercial paper, bankers' acceptances, T-bills, negotiable jumbo CDs, very much similar to a money market fund. It's just for municipalities. And that's called a local government investment pool. ABLE accounts have been deemed by the MSRB to be municipal securities. And if you get this, the test question is about the eligibility of 26. Direct participation programs, partnerships. You need to know about limited partnerships. You need to know limited partners provide the capital, whereas the general partner provides the expertise. You should know that partnerships have a pass-through of both profits and losses. So you're making a direct investment in the underlying asset, direct participation program. And so you're going to get what's called not testable, a K1, which shows the pass-through of either income or losses from the investment to you. Now, partnerships, very testable, are not liquid. You can't get in or out of a direct participation program, a partnership, without the permission of the general partner. So not liquid. I would know that REITs are very similar to mutual funds. REITs are very similar in that they provide you professional management, diversification, ease of ownership, but they do so in a portfolio of real estate investments. Both mutual funds and REITs pass through not losses, no, not losses, but pass through at least 90% of their net investment income. I think a good way to remember this is die 90. Die 90. If it's a mutual fund, die 90. D is for dividends on the stocks in the portfolio. plus interest on the bonds in the portfolio, less expenses, DIE, 90%. Most do much better than that. Remember, it's passive income, not losses. REITs are either offered in a private or public deal. So you can buy REIT like buying a stock, but you can also buy REIT in a private placement. If you're an accredited investor, you may be able to participate in a REIT that is being distributed as a Reg D private placement. And again, if you're buying any kind of a private placement, any kind of a private security, unregistered security, you should definitely understand that you're not going to have liquidity. Well, we have two types of exchange product traded products that you get tested on, very testable. You get tested on ETFs, exchange traded funds, and you get tested on how are they different than a traditional open-end mutual fund. They, unlike an open-end mutual fund, are not doing business based on the next calculation of the NAV. Like a closed-end fund, they're trading in the secondary market. You know, ETFs can be purchased on margin. They're marginable. You know, under Reg T, you're not allowed to extend credit as a broker-dealer on new issues. Open-end funds are new issues. These are not considered to be that, and so they're marginable. For test purposes, when I say for test purposes, that means I too know that outside of our discussion, what I'm saying may not be true. But for test purposes, exchange-traded funds are passively managed, and therefore they're more tax efficient. You have to be able to contrast an ETN with an ETF. And an ETN, test question, exchange traded note, is not an equity investment. You know, in an ETF, there's a custodian holding the monies and securities. In an ETN, it's a note, and the sponsor or distributor is agreed to pay you whatever based on the referenced index. That's interest they're agreed to pay you. And therefore, that means, test question, as a debt instrument, you have the risk of default. You have a creditor relationship to the sponsor or distributor of that exchange traded note. So very testable. If we are buying a different type of investment, for example, a hedge fund, hedge funds are organized as partnerships and they're sold as private placements. And we said in any kind of a partnership, including a hedge fund, they're going to be illiquid because you can't get in or out of the hedge fund without the permission of the general partner. And hedge funds typically charge 2 and 20. 2% of the assets under management, 20% of the profits. And therefore, you know, they have an incentive to take greater risk if they're getting 20% of the profits, but they're not taking any of the loss. All right, well, so what are some of the investment risks associated with various types of investment? So, you know, if somebody says, Dean, is my capital at risk if I purchase a security? I go, absolutely. Your capital's at risk. You know, how are you going to feel if you lose this money? If you're not comfortable with your capital being at risk, well, then maybe you shouldn't be in the securities markets, right? We have credit risk associated with the risk of default. We have currency risk associated with ADRs. If we're worried about inflationary or purchasing power risk, one good hedge for that is common stocks. Common stocks are a good inflationary hedge, purchasing power hedge. Over the long term, common stocks have proven to do better than inflation. I should say in my sleep, past performance is not indicative of future results. Fixed income investment vehicles typically are bad. I would add to this tips, Treasury inflation protected securities would at least keep pace. We've talked about the interest rate risk you have. Interest rates go up, your bonds go down. Interest rates go down, the bonds go up, but they get called away from you. We talked about that inverse relationship. We talked about liquidity risk. You know, stocks are very liquid because if it's a stock, and you know, we assume we're talking about a NASDAQ or New York Stock Exchange stock, you can turn that back into money on T+1. Very, very liquid. Even in an open-end mutual fund. The open-end mutual fund would cash you out at the next calculation of NAV within 7 calendar days. The thing we said to be very looking for on your exam is partnerships. Partnerships have that liquidity risk. Market systematic risk. So risks in the system. You know, the way I think of market risk is the tendency of securities prices to move together. When bad things happen to good stocks. And so here, even if you're properly diversified, risk prevails despite your diversification. So the test question here is I say, listen, one of the things you want to try and avoid is non-systematic risk or selection risk. The easiest way to avoid non-systemic risk is to diversify. Bernard Baruch, somebody's like, no, you ought to spread it around. And so the easiest way to do that is in a mutual fund. So in a mutual fund, you don't have non-systematic risk or selection risk, but you still have systematic or market risk in that mutual fund, right? So that's the test point. We talked about prepayment risk. Prepayment risk is associated with mortgage securities because when mortgages go, remember, interest rates come down, people refinance those mortgages. So we associate this with call risk in bonds, but also, more importantly, mortgage pass-through securities like Ginnie Mae's, right? And a Ginnie Mae portfolio of mortgages, if interest rates come down, everybody refinances this. It's going to end sooner rather than later, and that's called prepayment risk. Strategies for mitigation of risk. We talked about diversification. We also said you could hedge using options, for example. Right? You could, if you want to hedge your entire portfolio, you might buy an index put. And there'll be negative correlation as the market comes down and your portfolio goes down. The value of your index put goes up. Right? So we can mitigate some of that risk. All right. Well, that's the biggest part of your exam is securities. We're halfway through the mighty 90 minutes on your SIE exam. And now we're moving on to be talking about types of orders. Again, I think people get really hung up on this. There's not a zillion types of orders. There's just two. There's market orders and limit orders. That's it. Now, there are a zillion qualifiers or contingencies you can add to an order. But at the end of the day, it's either a market order or it's a limit order. The only order that has no contingency, no qualifier, is a market order. In a market order, I want immediate execution at the best available price. In a limit order, I want to do business at my price or better. Nobody has to do business with me at my price or better. Now, if I'm going to place a limit order with my broker, I want my price or better. So if Apple's at $2.20 a share and I want to buy on a limit, I'd say I want to buy at $2.19 or less. My buy limit would be placed below the market. If I want to sell Apple's at $2.20, I would put in my sell limit at $2.21. I want to sell for $2.21 or more. So a limit means, again, price is more important than execution. Right? I used to joke with my brokers. They say, Dean, are you buying the office lunch? I say, yes, I'm buy the office lunch on a limit of 1,000. I hand them 10 $100 bills and say $1,000 or less. Right? So there's an implied or better. Now, if you want, you can add another qualifier to your order. You can say, I don't want this to become a live market or limit order until it trades at or through. I want to have this be a contingent or qualified order, and I don't want it to go live unless the contingency or qualifier has been met. It trades at or through. That's called a stop order because the number one use of a stop order is to stop a loss. And so you could have a sell stop that you'd place below the market to stop the loss in a long position, right? You could have a buy stop to stop the loss in a short stock position. So that's why we call them stop loss orders because that's the number one use. Now, we have a great memory aid device to help you remember where you place orders in relationship to the current market price. That memory aid device is slobs over bliss. Slobs over bliss. Sell limits, that's the slob SL, and buy stops, or it's a buy stop turns a market or limit order goes above. Bliss, buy limits and sell stops go below. Right? So all orders are considered day orders unless you tell me differently. So unless you tell me GTC, good till cancel, it's going to be considered to be a day order. We have discretionary versus non-discretionary. If I am going to make a decision about action, asset, or amount, action, whether to buy or sell, asset, which security to buy or sell, the amount, quantity, three A's. If I'm going to make a decision about one of two or all three of those A's, I need discretionary authority. I do not need discretionary authority to make a decision about time and price. Maybe I have discretionary authority, but I call you and say, hey, listen, I'm not comfortable using discretion in this particular example, scenario. So what I'd like to do is, with your permission, let me share the idea with you and get your permission. That would be solicited, discretion not exercised. Solicited means it was my idea. Unsolicited means the customer's idea. The customer calls me and I say, well, that's very foolish. When we're trading securities, if the security is trading over the counter in a negotiated quote driven market, there are going to be what we call market makers. And a market maker is going to post a quote, a bid and an ask, a price at which they're willing to buy the security into their inventory, their bid, and a price at which they're willing to sell the security out of their inventory, the ask. The market maker buys at the bid and sells at the ask. The customer is on the opposite side of that quote. The customer, when looking at a price, always pays the high price, always receives the low price. What's that called? The securities industry. I'm joking. It's called the spread. The spread always means difference, right? The spread means difference. So if I say, as a market maker, you work at an order entry firm and you call me and I'm the market maker, you say, Dean, I'm looking for a quote. I say, my quote is 15, 16, 8 by 7. So what does that mean in plain English? That means I'm willing to buy 8 round lots into my inventory at 15, and I'm willing to sell 7 round lots out of my inventory at 16. So that's what that means, 8 by 7. Round lots, 100 shares. You say, Dean, we're buying 700 shares. I say, change my mind. Very testable. They'll say on your exam, a market maker fails to honor a firm quote. This is a prohibited practice and is known as, and you got to come up with selling away. Or excuse me, selling away, my bad. Backing away. Backing away. So we'll say a broker-dealer fails to honor a firm quote. There's a prohibited practice known as backing away. By the way, selling away is also a test question, but that's when an agent of a broker-dealer sells an investment not sponsored by the employing broker-dealer without permission. So that's a different violation. Now, on your confirmation, we're always going to tell you capacity. What does capacity mean? We're all called broker-dealers, but in any one trade, we're either going to be a broker or a dealer. So, I work at Goldman Sachs. You say, hey, Dean, at Goldman Sachs, you're a broker-dealer. I say, yes. So what that means, in some transactions you do with us at Goldman Sachs, we're going to be acting in our broker agency capacity. And on your behalf, we're going to get the security elsewhere, and you're going to owe us a commission. And other transactions you do with us at Goldman Sachs, we'll be acting in our dealer principal capacity, and we'll be charging on markup or markdown. We will always disclose to you in each and every transaction in what capacity we acted, in our broker agency capacity or our dealer principal capacity, and we'll never do both. It'll be one or the other. So that's called trade capacity. Good way to remember this is ABC, agent broker commission, or DIPM, 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 dealer inventory principal, markup, markdown. All right, so in terms of bullish and bearish transactions, right, there's all kinds of different, we said the two basic ones are selling a stock would be bearish. Again, that'd be an opening sale. You're going to sell borrowed securities. Now, if you're going to sell borrowed securities, there is a requirement, a locate requirement, that we find the securities before we sell them short, selling borrowed securities. And so I'm going to call stock loan and see if we have a client who signed what's called a loan consent form. And then we said that long stock would be bullish. We said investment returns. You should be prepared to know the investment return from an investment would be the what you get from the income stream plus or minus what you get in price appreciation or depreciation. And we said one component of a stock's return would be a dividend if declared, right? Some stocks have dividends, some do not. But dividends, if it's declared, a cash dividend is going to be taxable. Stock dividends are not. So, you get a Bank of America pays a 21-cent quarterly dividend. So that's 84 cents um, per share. And let's say I own 1,000 shares times 84 cents. That's $840 in dividend income I'm going to receive from Bank of America. And that $840 is taxable. Now, if Bank of America pays a stock dividend, that's not taxable. They give you a 10% stock dividend. In my example, 10% of 1,000 is I'm getting 100 shares. So now I own 1,100 shares. The way to get this right on your test tomorrow or today, depending on when you're watching this, is don't get too hung up on the math. You're just going to have more shares at a lower price. Now, a dividend of one corporation paid to another corporation is 50% tax excludable. Now, there is a process that is testable for receiving the dividend, a chronological sequence. And remember, in the secondary market, people are buying and selling Bank of America stock. The shareholder list is always changing. And so when Bank of America declares a dividend, they're going to say, we're going to look at our shareholder list on, I'll just make up one, Thursday, September 16th. And if you're a owner, shareholder of Bank of America on Thursday, September 16th, you get the 21-cent dividend. If you're not a shareholder on Thursday, September 16th, you do not get the 21-cent quarterly dividend. Interesting. So here we know that we should know that it takes on the Uniform Practice Code 1 business day for ownership to change. The Uniform Practice Code standardizes trading practices within the securities industry. And regular settlement is when ownership changes hands. So trade days when we agree to terms, settlement is when ownership changes, is T+1. So if I'm going to buy Bank of America stock, it takes 1 day to show up on the shareholder list. In my example, let's say they say we're going to pay the dividend to shareholders as of record October 1st. Or excuse me, as of record Thursday, September 16th, we're going to actually pay the dividend on October 1st. Okay, so when these 3 dates are set by Bank of America, the declared date, the record date, the payable date. Those are set by the board of directors. Now, X is Latin for without. The X date, very testable, is the first date on which the stock no longer trades with the dividend attached. So in my example, if I buy Bank of America on Wednesday, the 15th, T+1, I'm on the shareholder list, I get the 21 cents, right? So Wednesday would be the last day I could buy the stock and still receive the dividend. If I buy it on Thursday, the 16th, the record date, I'm not going to be on the shareholder list. I won't be on the shareholder list until Friday, the 17th. So I'm not entitled to the dividend. So the first date on which the stock no longer attached is going to be the same as the record date. The X date, 2 test questions. When is the X date? What is the X date? What is the X date? It's the first date on which the stock no longer trades with the dividend attached. When is it? It's the same as the record date. So that is one of the reasons I'm redoing the Mighty 90 here, is because the very popular your SIE in 60 minutes, I still think it's worthwhile. I disclose everywhere in the video description. I've got half a dozen videos and updates. But this is the major update that people are always complaining about, that the settlement dates used in some of the older material has this, even though I have 6 videos that walk you through this. I'll tell you what I'll do. I'll link in the video description to a little, update and how this plays out in terms of practice questions. Now, we would assume that the Bank of America stock is going down by the amount of the dividend on Thursday, September 16th, right? So very testable. We said we also should be able to do current yield and have a general understanding of total return. relationships of yields, right? Cost basis, they might ask you again to recognize this idea of cost basis as it relates to a stock dividend or stock split. I'm not going to go over that in this because this is the mighty 90. And I told you in almost every circumstance, you can get this by just knowing I'm going to have more shares at a lower price. You know, some of us get paid based on our performance against a benchmark or an index. And I would know the benchmark for the stock market as a whole is the S&P 500. I would know the benchmark or index for a small cap market is the Russell 2000. I would know the index that best approximates the total U.S. stock market is the Wilshire 5000. And I would know that the only index or benchmark that is price weighted is the Dow Jones Industrial Average. We've talked about settlement. We said settlement is T plus one. That's called regular way settlement. There are irregular ways to settle trades, you know, but we always assume people are doing regular way. But if you want to have it settled same day, you can do cash settlement. Now be careful. We're not talking about a cash account where you intend to pay in full. Cash settlement. Cash settlement is when you want ownership to change the same day. Some securities are book entry settlement, meaning there is no physical certificate. And book entry settlement would be US Treasuries and state GOs. Some corporate actions you get tested on. One of the things that corporations do, as we mentioned, is buy stock into their treasury. You know, and some companies do this by simply going in the open market and buying their own stock. Other companies buy the treasury stock by making a tender, an offer to their existing shareholders. And whether it's a tender that comes from the issuer to buy treasury, or whether it's a tender offer from X to buy Twitter, I would know that any tender offer made has to remain open for 20 days, right? We talked about the issuer doing a stock split. But now we would assume a stock split is going to be a forward split, right? So if it's a 2-for-1 split, you had twice as many shares at half the price. But every once in a while, embarrassing, a stock will do a reverse split. And there you would have less shares at a higher price, right? Customer accounts and types of accounts we have. The two basic types of accounts we have are cash accounts, where you intend to pay in full, and margin accounts, where you intend to pay part of the purchase price. And I would know that there are some accounts that have to be cash accounts. The big ones on the test are uniform transfer to minors accounts, uniform gift to minors accounts, custodial accounts, and retirement accounts should be cash accounts. Margin accounts are where you intend to pay part of the purchase price and you'd like the broker-dealer to lend you the balance. And there we're going to have additional documentation, very testable. We're going to have a credit agreement, which is mandatory, that tells you you're borrowing money, you're paying interest. We're going to have a hypothecation agreement, mandatory, saying you understand you're pledging your securities as collateral for the loan, and therefore your securities are going to be in street name, the name of the broker-dealer, so we can sell you out if you don't meet your responsibilities. And remember, we have a loan consent form, which is not mandatory, which we say, hey, you know, we'd like to be able to lend securities to your securities our customer wants to go short. That's not mandatory. We talked about the, again, documentation required to open an option account. We said data 15, we got to give them the disclosure document, get the account approved, do the first trade within 15 days, get back that option agreement. Otherwise, there's going to be nothing allowed except offsetting transactions. Discretionary versus non-discretionary. If we have a discretionary account, we got to have discretionary authority in the account prior to the first trade. Some of you are on the first leg of a testing journey that will include a 7 and a 66. And, you know, 66 means you're going to be an agent of a broker-dealer and an investment advisor representative. And the number one reason you would be doing that is so you can offer what are called wrap accounts, where we wrap the products and services of our broker-dealer and our investment advisory service into one fee. It's called a wrap account. Test question there is we'd have to give you a brochure that tells you what's included in that fee, what's excluded in that fee. So fee-based accounts, if we don't have a 66, some of you are going to take a 663, 763. There you're being compensated, your firm and yourself, typically by commissions. We talked about educational accounts we offer. We said the 529 versus the Coverdale, and you always tell me the 529 is better. How does the customer want the account registered? Very testable. So what you got to be able to do here on your exam is contrast joint tenants with rights or survivorship with tenants in common. With joint tenants with rights or survivorship, there's no fractional interest ownership. The decedent share goes to the surviving party. With tenants in common, there is a fractional interest, and the decedent share goes to their estate or beneficiary. Very testable. If we're opening a corporate account, we need a copy of the corporate resolution. If they want to do margin, we need a copy of the corporate charter to see whether margin is specifically permitted within that corporate charter. So corporate accounts, corporate resolution, which corporate officers can be allowed to trade the account. And we need to have a corporate charter if they want to do margin. If we're doing a trust account, we need a copy of the trust agreement. We said custodial accounts, no margin, very testable. One minor, one custodian per account. Very testable. The minor's tax ID number goes on the account. If we're opening an account for a partnership, we need a partnership resolution, which partner is authorized to transact. If they want to do margin, we need a copy of the partnership agreement to make sure that's specifically permitted. Now, retirement accounts are funded with pre-tax money. And I would definitely note for the vast majority of retirement accounts, except for Roth, the required minimum distribution is 73. This is another reason I'm updating to the mighty 90. So, when people say, oh man, this thing says it's 72 and it says it's T plus 2. I go, well, that's because, things change. They don't change a lot. Do I think that I need to delete any of my existing videos that refer to T plus 2 or RMDs as 72? I do not, because again, in every video description and pinned comment, I tell you those updates. However, this is an updated version called the Mighty 90. I would know RMDs are 73, except for Roth IRAs. There is no RMD for a Roth IRA. Anti-money laundering. Definition of money laundering. Well, what we're doing in money laundering is 3 stages to turn our dirty money into clean money. And the definition of this is going to be placement, layering, integration. And the easiest place to prevent money laundering is in the placement stage, right? Where are we going to put the dirty money? Stages of money laundering, well, we just talked about. Structuring is when somebody's trying to avoid the CTR. A currency transaction report test question is for $10,000 or more. That's going to trigger a CTR. It doesn't mean I'm a crook, and I like to carry. I'm a guy who gets cash, and sometimes I get more than 10,000 cash. That's going to trigger a CTR. We all have to have an AML. Now, structuring would be where Dean says, I was getting a chunk of money and it was taking long. My mom was with me, and I was going to give mom some money, so that's why she's at the teller window with me. And she goes, "Man, what takes so long to get your own money?" I said, she's got to fill out a CTR. And then she kind of looked at me like, "You know what the heck that is?" I go, "Yeah." And then my mom said, "Well, why don't you get make 3 withdrawals for less than 10?" That's called structuring, where it looks like Dean is trying to avoid triggering the CTR. Every firm has to have in its WSPs a section on money laundering, anti-money laundering. Those are called the WSPs, the written supervisory procedures. SARs, so we talked about 2 here, a CTR and a SAR. A suspicious activity report test question is for 5,000 or more. And that would be for something that's commercially illogical, like structuring, origin of the funds, something that is, doesn't make any sense. Those are going to be filed with FinCEN. And when we open an account, we want to check and make sure that client is not on OFAC with the Office of Foreign Asset Control to make sure this is not a person we're not supposed to be doing business with. Now, what gives us the authority to give this information to the Department of Treasury? And that's testable. It's called the Bank Secrecy Act. Don't you love it? They name things the actual opposite of what they are. So the Banking Secrecy Act gives us the financial institution the authority to release this, information. Books and records. The vast majority of brokerage from records are 3-year records. There are very few records of a broker-dealer. that are lifetime or 6. The vast majority are 3. The exception would be customer complaints, which is a 4-year record. Confirmations and account statements. We're going to have to give you a statement quarterly, very testable. There's a testable exception to a quarterly delivery of a statement. It would be monthly if you have a penny stock in your account, very testable. A penny stock is a non-NASDAQ stock under 5. Can we hold your customer mail? The answer is yes. We could, with written, authorization of yourself. And if you want to extend that, it can't be just because of convenience. It's got to be something like security. All firms have a business continuity plan that's linked on the website and also have to have a link to broker check. So the BCE, what happens, how we can continue to conduct business in the event of a natural disaster or terrorist attack, whatever the case may be. We have to make sure we have protection of your identity and your proprietary information. So, we're going to have access to non-public personal information, the confidentiality, what are we doing to protect that? If we want to use that for any other purpose than what you gave it to us, we would have to have your permission to do so. Communications with the public. You should definitely know the definition of retail communication, more than 25 in a 30-day period. You should know that requires pre-distribution approval by a principal. You should definitely know correspondence is 25 or less, and that can be approved by a principal pre or post distribution. You should know that if we're going to be doing cold calling, we can't cold call before 8 in the morning. We can't cold call after 9 in the evening. We have to maintain a do not call list of people who ask not to be bothered. We're not supposed to engage in rumor mongering. We're not supposed to engage in a pump and dump. A pump and dump, if you saw Wolf of Wall Street, that's a real guy, Jordan Belfort. His firm was Stratton Oakmont, and that's what they did. They did pumps by selling the stock, not allowing anybody to sell, and they sold. Fraud running, big no-no, trading ahead of customers. Excessive trading, again, very testable, very prohibited. That's churning. Trades are excessive in size and frequency. Those are all things we're not supposed to do. If a customer buys and sells without paying for the buy, that's called a free ride. And when a customer does a free ride, we're going to freeze their credit privileges for 90 days. I would definitely know that in our WSPs, besides having a section on anti-money laundering, we also have to have a section on insider trading. I would know that insider trading, what is insider information? It's material non-public information. I would know who is involved in this, anyone who has access to material non-public information. I would know that fines are both civil and criminal. I would know the civil fine is 3 times the profit. So if you make 3 million, you owe 9 million. Boom. Can you participate in a customer account? This one's kind of a unique one. The answer is yes, with proportionate capital and principal approval, right? Every firm and its WSPs have to have a section on how we're protecting seniors, how we're preventing the exploitation of a senior. I would know a senior is 65 or older. I would know that most of us do it by asking politely to have a trusted contact person. So this is not somebody who has control of the account. It's just somebody we can reach out, and we can put a temporary hold on transactions until we contact that trusted contact person. The initial hold is 15 days. It can go longer depending on the circumstances. All right, so we're doing our mighty 90. We're closing in on our 90 minutes on the SIE, which is a revision of our 60-minute version. And I told you our 60-minute version was people who were asking about, gee, Dean, can we do an update? Even though I think that is very much something we should have a handle on. All right, so another thing we get tested on is the regulatory authorities. We should definitely know that the SEC has primary jurisdiction, interpretation, and enforcement of the domestic securities law of the United States of America. The 2 big ones here on the test are 33, known as the Paper or Prospectus Act, 33 says you're going to sell brand new securities to the public. You have to make a registration statement, hence the term registered securities. And if they haven't gone through that process, then they're unregistered securities. There are some safe harbors available under 33. And then 34 is the people can get right by covering the screen, people and places, right? So cover up the screen. Are they asking me about prospectuses, paper? That's 33. People and places, that's 34. FINRA, the MSRB, the SIBO are what we call self-regulatory organizations, right? They're SROs. They don't have a badge. They don't have a gun. We have the Department of Treasury. We said the Department of Treasury is responsible for FinCEN, those CTRs, those SARs, money laundering. We have state regulators. Some of you are coming back to take another test, 63, 65, 66. Those are the state regulators. So on the federal level, as a retail investor, I get protected by the SEC. On the state level, as a retail investor, I'm protected by my state administrator. And those are, they have a club called the National North American Securities Administrators Association. You will be taking an exam based on that. We have the Federal Reserve Board, which is the regulator for banks. We have very testable SIPC, the Securities Investor Protection Corporation, which is for 500,000, which covers you if your broker dealer fails for $500,000, of which no more than 250 can be cash. That's very testable per separate customer. And on the banking side, we have FDIC, that is very testable, and that protects you for up to 250 grand. Market participants, we said that we have broker dealers, we have investors. Now, in the investor category of market participants, we would definitely know what an accredited investor is. The purpose or the reason you are an accredited investor is that would allow you to participate in a Reg D private placement. A good way to remember the definition, very testable, of accredited investor is 1, 2, 3. $1 million net worth exclusive of your primary residence, or $200,000 for the last 2 years with the expectation of $200,000 this year, or married and filing jointly, $300,000 for the last 2 years with the expectation of this year. If you're going on to take your 7, you too would be an accredited investor. A 7 in good standing is also considered accredited. On the institutional front, we should know there's a particular type of institutional investor called a QIB, a qualified institutional buyer of securities. If you encounter this on your exam, the test question is, what is a QIB? It's an institutional investor with $100 million or more in assets under management. Test question number 1. Test question number 2, it allows them to buy unregistered public and private securities. I should say unregistered foreign and domestic securities. And one of the transactions you get tested on is what's called a PIPE, a private investment in public equity. A private investment in public equity. And that typically would be a QIB, or it doesn't have to be, but that's where we're buying unregistered stock in a public entity, and then we keep it for 6 months and we hope to, be able to make some money on it. Investment advisors. An investment advisor is a firm that gives ABC, gives investment advice, tells people they're in the business of giving investment advice, they want compensation for that. Municipal advisors provide advice to municipal issuers. So we have typically at a broker-dealer corporate finance, men and women who raise money for corporations, and public finance, men and women who raise money for municipalities. The MSRB says that if I'm a municipal advisor, I can't switch my role from being the advisor to being the underwriter. Because, that'd be a conflict of interest to be representing the issuer, representing my broker-dealer, and representing my clients and selling the bonds to them. We have issuers. We said, again, 3 issuers you're held accountable for: corporate issuers, municipal issuers, US Treasury. And again, we have primary and secondary market transactions. We should be able to contrast an auction order-driven market like the New York, where they're matching buyers and sellers, hybrid, a little bit of both, but with the over-the-counter market, where we're negotiating a quote-driven, right? So we get held accountable for the primary market, where the issuer is receiving the proceeds. We get held about the secondary market, where the previous owner is receiving the proceeds. Another market I would be aware of is the third market. So this would be like ABCD. Third market is listed securities traded over the counter. And then the fourth market, test question, is direct trading between institutions. So those are the type of markets you're held accountable for. You do get tested on economic factors, and you get tested on monetary and fiscal policy. Monetary policy is the money supply controlled by the Federal Reserve Board. We don't want to have too much money or too little money in the economy. We want price stability. The mission of the Fed is price equilibrium and full employment. Fiscal policy, test question, is government spending and taxation. Tools of the Fed to make sure we don't have too much money, inflation, too little money, deflation, is open market operations. Through open market operations, the Fed buys government securities. When they buy government securities, the money supply goes up and interest rates go down. When the Fed sells government securities, the money comes in, money supply goes down, interest rates go up. Right? The interest rates is the important. You do get tested on the various interest rates, and there's four you're held accountable for. The discount rate set directly by the Fed. That's the only rate directly set by the Fed. The Fed funds rate, which they target, test question, the Fed funds rate is the most volatile of all the rates. That's a test question. The Fed funds rates is banks with excess reserves lending banks with deficient reserves. And, the other two are prime rate. That's what banks charge their best commercial customers. And broker call. That's what banks charge broker firms, and that's the rate used for financing margin accounts. I doubt you're going to get too much on financial statements, but the financial statement would be the balance sheet and the income statement. And if we're using the balance sheet and the income statement to make analysis, that's called fundamental analysis. And we're either doing fundamental analysis where we start with the economy, then the industry, then the stock, or bottom up, stock, industry, economy. And what we'll be interested in the economy is the business cycle. And it is very testable to know that 2 calendar quarters of declining GDP is considered the definition of a recession. I would definitely know about defensive stocks. A defensive stock is a stock, a corporation delivers products and services resilient to the business cycle, like food, for example, like utilities. Nobody wants to go back to the Stone Age, right? So defensive stocks. In terms of economic theories, there's one that is based on demand side, founded by Lord John Maynard Keynes. And Lord John Maynard Keynes said the government, when the economy is weak, it's because there's a lack of demand. And so what the government should do is step on the accelerator, stimulating demand through fiscal policy, government spending and taxation. Mr. Keynes would have been, approval of what was done during COVID in terms of fiscal policy. Of course, now there's some people that say maybe the government overstimulated demand and sparked inflation through using demand side economics. Oh, well, whatever floats your boat. So one of the economic theories, your theory isn't truth, just a way of explaining things. The more a theory can explain, the better that theory is. You do get tests on balance of payments, the trade deficit, right? Balance of payments, US money going out, foreign currency coming in, this idea of debit and credit. So, what we like to do is our Japanese friend buy $10 billion worth of Boeing airplanes. We give them the planes, they give us the yen. That's a credit to the balance of trade, right? If we buy $300 million of tequila, my Mexican friends give us the tequila, we give them the dollars. That's a debit to the balance of trade. GDP, test question, is the total goods and services an economy produces. When we refer to what's called the spot rate, that's the current exchange rate of the yen to the dollar or the peso to the dollar, whatever the case may be. So when I say what's the spot rate on the peso, I'm asking what is that right now? We have various safe harbors, very, very testable. Various safe harbors. ways to sell securities without running afoul of 33. So types of offering, public versus private. So we do get tested on various exempt transactions under 33. One of them we get tested on is Reg D, very testable. Reg D is a private placement. I have an unlimited number of institutional investors and accredited investors. We talked about that definition, right? Reg D. And in a Reg D offering, we have two versions, 506B, where I can have up to 35 non-accredited investors, but I can't solicit. 506C, where I can't have any unaccredited investors. I can have institutional only and accredited only, but I can solicit. We have Reg A offerings where I can raise up to a max of 75 million. We have Rule 147, intrastate offerings of securities, where the issuer has to have 80% of their business and assets within the state. I can only sell it to residents of the state. And we have, what else? Rule 147, Reg D, Reg A. I think that's good enough for that. As a banker, when I'm doing a public distribution of securities as an underwriter, my syndicate is either going to tell the issuer we'll extend our best efforts, we'll do our damnedest to sell those securities, but we're not willing to buy them personally. Or we're so confident we can sell these securities, we're going to do a firm commitment underwriting. Firm commitment means as far as the issuer is concerned, the securities are sold. Now, as a banker, I say, listen, we might want to come back and raise additional money. So what I'd like to do is a shelf registration. Better to have these securities on the shelf at the SEC registered and not need them than need them and not have them. So with a shelf registration, if we're a well-known seasoned issuer of securities, our shelf registration would be good for up to 3 years. So for up to 3 years, we can take down our shelf and use it. For example, Disney used their shelf registration to pay for Fox. They gave the Fox shareholder Disney shares to make that acquisition. By the way, for the Fox shareholders, cash would be taxable, but stock in Disney is not, right? So that's a shelf registration. Okay. Well, by the way, there's different documents, and munis are exempt from 33. So we don't have prospectuses when selling munis. We have what's are called official statements. And in private placements, we have what's called a private placement memorandum, a PPM. In Reg A's, we have offering circular. So we have different things. And remember, just because we're exempt under 33 doesn't necessarily mean that we're exempt with the state administrator. We may still have to register. That's called blue sky laws. Blue skies laws are how we register a security within the state. You're going to take a whole exam on that later, right? 63, 65, 66. Okay, well, I think I came in under the mighty 90 in about 90 damn minutes, so pretty impressive. Now, let me know your thoughts on the mighty 90 as it compares to the SIE in 60 minutes. We're now update. We're now current. Remember, inch by inch, your SIE exam is a cinch. Yard by yard, your SIE exam is hard. And I will see you on the SIE. Well, I guess I won't see you on the SIE playlist. Assuming you're watching this the night before or morning of or both, I guess I'll see you next on the Series 7 or Series 6 playlist. And I hope to have a mighty 90 up shortly for that. I'm coming to you in the beginnings of January 2025. All righty, everybody. Thanks for spending 90 minutes with me.